Nash is currently VP of Solutions at Convo. It's a homegrown startup that started from Islamabad but is currently based in Silicon Valley. The venture is working to eliminate email from work and replace it with better communication tools. I am very excited to know more about this. He founded a startup called Pring, a Pakistani social network where any user with a cell phone could join without internet. Based on his experience, he is in a perfect position to talk about how to raise money for your startup. So, ladies and gentlemen, please welcome Nash.
Thank you, Amreen. Hello, everybody. I hope you're all having a good Saturday morning. For those of you who are interested, I've actually uploaded these slides online, and you can maybe follow along if you want. I've also posted these on Twitter. So I'm Nasrullah, and I founded a few companies. I'm currently working at Convo as VP of Solutions. And so yeah, you can sort of get in touch with me on Twitter or via email here. So I've actually, I raised $2 million too late. It's not a lot of money, but some of the key things was that I raised this very early on, maybe 1 or 2 years after I graduated. I was a fresh student, fresh out. And second thing was all this money was raised from within Pakistani investors, which is incredibly hard. So this is a summary of my experience of some of the things I went through while working with investors in Pakistan. And I'm an engineer by training. I'm from GIKI. My passion is still engineering and sales. And this is just a quick run through of all the stuff which I've learned. And time is short. I prepared 50 slides, so just bear with me. Alright, so fundraising in general sucks because when you want to start a company, when you're thinking about doing something new, you want to focus on that thing. Fundraising is sort of a distraction in which you sort of have to get money to complete the vision that you're thinking about doing. And it's important to get this right because what you want to do is you want to be able to raise money so that you're able to run this company. So everything I talk about today, there's going to be an exception to every rule. Nothing is written in stone. Anything that I talk about, you can find a different way of doing that. This is my personal experience. You can find different ways of doing so. I'm just going to walk through 5 key areas. I'm just going to walk one by one through them. Now, a key thing about raising money, the first thing you have to understand, there is tension between 2 things, control and wealth. So businesses are started every day in the whole world in Pakistan. Every dukaan is a business, every petrol pump is a business. The difference between a startup or a company and a small business is control versus wealth. In a business which is a small or medium business, it's controlled by a single person. Usually these are sole proprietorships. It's a single person running a shop. And if you keep 100% control, you won't be able to grow very large. You won't have many people involved. And any business that you go to, whether that's a shop, etc., they have a lot of control. On the other end of the spectrum, you have wealth, and this is in the form of private limited companies. You go fast, you grow fast. Compared to these smaller companies, these are basically, they grow organically. So there's no right or wrong way. You have to figure out at which point in this do you lie. For example, Box, the company which makes file sharing, when they did the IPO, the co-founder owned only 2% of the company. But then the pile was so large, it still made bank. So you have to decide early on that once you're raising funding, you will be giving out control because once you put money inside the company, you're actually adding more people who are going to be overseeing you, right? There's a good book on this, it's called The Founder's Dilemma, which covers more about this topic. Now, to be able to fundraise well, the best thing to do, just like doing sales, just like doing design, just like doing marketing, you have to empathize with your users. You have to understand where your target market is coming from. So think about a typical investor. It's like a 40 plus years of age. Usually they have either family wealth, old wealth, or they're self-made. And they have some disposable, riskable money that they can spend. And they believe in the market potential, right? Now think from their point of view. Now which of these 2 boxes would you choose? You have two options. In one box, you put in $1,000, $100,000. In 3 years, you'll get $150,000. In the second box, you put in the same amount of money, but in the same amount of time, you get $1 million. Now that's a no-brainer, right? I mean, this is a simple decision to make. What complicates things is the fact that there are risks involved. So let's change the question again. If in the first case, it's $100,000, you get 150 with 90% probability. In the second case, you put in the same amount of money, but there's only a 10% probability that you might make it to $1 million. And the downside is 90% of the cases you might lose everything, right? So an investor typically faces decision. The first is generally a bank. This is like a 16% annual interest tax which you get by the end of maybe 3 years. Second case is that if you invest in a startup, you might actually end up hitting big. You might have a 90% failure rate. And so that's sort of the mindset that investors coming in from, right? And what you want to do is you want to address the risks which make the probability higher of your success. So when talking with investors, a really great piece of advice is by Mark Sisters, basically be a dot, not a line. So for example, let's say you're meeting with an investor, then the first time you're meeting anybody, you are a dot. You are meeting someone for the first time. You tell them your idea, you talk about what you've done, but right now you've just a data point, which means this is where I stand right now. In 3 years, I want to do this, but this is what I'm doing right now. So, in order for you to build a reputation with the investor, you need to be aligned. Meet them again after 3 months or whatever amount of time, and show them your progress. So, if my recommendation is that you meet investors early on. If you're starting a company, go ahead, meet those investors, even if you've done nothing. Tell them that this is my plan, this is what I intend to do. And once you come to the investors and you say, look, I've actually been able to do this stuff, now they have actual data to go on, that you came back, you said you have 100,000 users or whatever. And so it builds more credibility in that mind. But the thing you need to be careful about is, are you a good mind, right? So for example, if you are the blue dot, the no progress, you've not made any changes, then you've not really made any progress here. You can become worse than before, you could be on plan as projected, or you could be better than what you were doing. But meeting investors, maybe on a frequent basis, builds that data in their head, and every success that you get adds confidence in your ability to execute, right? So, startups are basically about growth. That's one of the differences between a small or medium business, a shop versus a startup. What you want to do is you want to be able to get your value quickly, larger. You want to generate business quickly. So let's say that today you work $0, and in 3 years, like 1,000 a day, you want to be worth about $1 million, maybe in revenue or what you want to choose. Now, for every day you're on plan, you're adding $1,000 to your company's value. Let's say from 0 to $1 billion. The more you stay on course, the more you're able to execute your vision, you're able to reach that valuation by, let's say, that amount of time. And so, the questions you should ask yourself is instead of 1,000 days, could I bring this down to half, to 500, to 200? And that's what excites me about startups. You can basically push things faster and do things quicker, depending upon the area you're on. And that's why, that's what is exciting about startups, is that they're able to gain value very quickly. But in truth, your growth is going to be more like this. There's not going to be a straight line. It's going to be all over the place. There are going to be high highs and low lows. But if you draw a line between these dots, you will still see a pattern, and that pattern tends towards the top and right. So those 90% risks that we talked about earlier in that investment example, what you want to do is identify what are the risks which might harm my business or which might destroy my plan. And you want to eliminate those risks up front as quickly as you can. You want to do little experiments to prove or disprove your hypothesis, and just quickly reduce them. So for example, if you are, for example, the 3D cake example, if you're going ahead to do that, the first risk would be, is it even possible to do this? Are you able to import machinery? Will this work in temperatures of Pakistan? Will people buy this? These are all risks. If you're able to, yes, import the machinery, yes, make a prototype, you're basically reducing your risk, and the probability of failure goes from 90, goes down to 80 and 70. So that's what you want to do here. So there are different ways to value a company, and I'm not going to go into detail, but I think the key point here is demand and supply. It's basically the amount of, so think of it this way. Regardless of what you might value yourself at, regardless of what you might think your company might be worth, at the end of the day, the question is, how many people are willing to buy, or how many people are willing to buy those shares? And what is the demand for that? And if there's not a lot of demand, the price of your company will be driven down. And what you have to do in fundraising is to create competition. And I'm just going to talk about that in a slide coming up. To create a better valuation for your company, you have to be at a more mature stage. At any point you can raise money, at any point you can talk to investors, but there's a spectrum. At the very beginning you just have an idea, and if you're nobody, if this is your first company, if you have no track record, an idea has very little value. But if you're somebody with a track record who's sold companies, if today, for example, Mark Zuckerberg wants to make a rocket ship to Neptune, an impossible idea, people will still invest in that because of his track record, right? So you can start from just an idea. The next step would be a working prototype. You're actually able to demonstrate you can make that idea. The third step, or further down the line, is not just you're able to make something, but you're able to show that users are using this. Another step would be that you figured out that users also find value. There's a fit with the product that the user needs. And then eventually if you have paying customers. So that's the spectrum. The better down you are here, the more risks you've eliminated. The idea has been realized, you have users, they like the product, you have paying users. So at any different stage that you go on, the further down you are here, the more risks you've eliminated and the better you will be in terms of gaining, let's say, investment, things like that. So when you're meeting an investor for the first time, and you're not somebody who's, for example, done investment fundraising before, you want to build credibility quickly, and you build credibility the same way you do it in real life, the same way you do it inside sales, the same way you do it in any other place, and that is by associating yourself with something the investor respects, and all of you have something which other people will respect. For example, if you went to a school you can quote, I went to Stanford, GIK alums, Nasrullah, secretary, you mentioned that. I went to an incubator, because for example, saying I went to Stanford means that admission process, I went through all of that, I went through competition, I was able to get to that point, so that builds some credibility. By going into an incubator shows the same thing. I won a competition. I'm not a big fan of competitions, but if you won a competition, that also proves, or I worked at a company that Google worked me. So these are all things you can say, which even if you've not done a startup, you can still build credibility with someone you meet for the first time. And you can do this in the first 30 seconds of your conversation. For example, hi, I studied at Nash, I got selected for the LCE, we won the T50 contest, etc., etc. And, or for example, you get an introduction from somebody the investor respects, or for example, if you got press coverage, or if you're already on the media and there's already credibility built from that. I just thought I'd throw this in there, a lot of people here. I found this recently, for Elon Musk's actual innovation is how good his hair has become after losing it. Right back to business. Alright, so initially, because you don't have a running history, a credibility to go on, typically the first round of fundraising is what is known as the 3F, the friends, family, and fools. These are people who invest in you not because you have a good track record, because they know you on a personal relation and they want to see you succeed, and they don't really, the money they give you, they don't really care about whether or not you're going to make this into a big thing or not. They're sort of supporting you in that. But despite that, you should treat this professionally, and your goal should obviously be to build and make this big. And you should use that initial funding to sort of build a prototype, get user traction, and then sort of go from friends and family around to getting more angel investors or larger investors on board. So, as long as you're in Pakistan, so we obviously don't have a lot of investors, we don't have a lot of money to go around, and that's one of the key problems we will face as being an entrepreneur in Pakistan. My recommendation is that an entrepreneur's job is to solve problems, and lack of funding is a problem you have to solve. As a matter of fact, in some cases, it would be the number one problem you might have. So you have to do whatever it takes, whatever KPIs you have to fulfill to raise that funding. And if you hear stories from anybody who raised funding in the last few years or even before, you will hear a lot of war stories. And for example, even if you're raising funding from abroad, Pakistan, a Pakistani entrepreneur will probably have to do 3 times more than a typical entrepreneur would, for example, in the Valley, who raise the same amount of money. There are a lot of things you have to prove. There are environmental factors that you have to disprove. You have to build a sense of security. You have to make them understand that you're able to run a first-class team in a country which is currently not known for first-class teams. There are not a lot of startups from Pakistan which have done this. It's slowly changing, but it's an uphill battle. A way to stay afloat is to reach break-even as soon as you can. Don't expand too fast. And the reason is that if you are only working on funding, let's say you're a company which is working on funding, then there is an end date to that funding. There's going to be a point when that funding is going to end, and when it ends, you have to raise more, which sort of puts you at the mercy of investors. This is not usually a problem in a place where there's a lot of investment available, but if there isn't, you're sort of putting your company at risk every time you have to raise investment. But if you are break-even or profitable, this gives you the ability to pick and choose the sort of investors you want, and this will sort of slow down your growth, but it's better than having an instant death because you run out of funding. It's not exactly ideal, but currently in I think Pakistan is sort of in the 1950s of what the US was in terms of the VC market, or maybe even earlier. So these are some of the things I think we can do to survive. So who do you fund this from? So there are not a lot of institutional investors. I provided a good report on the ecosystem of Pakistan, the PEER report. I suggest you go through that. It talks about a few angel investors, a few venture funds which operate in Pakistan. But in general, the profile I talked about previously, the 40 years of age who has disposable income, any person who has an appetite to actually take on 90% risk is someone who has maybe that money, and then you want to look for people who are maybe successful in your field. This is important because they will understand what the problems are you're going to face, and they can help and guide you. And this is especially true for self-entrepreneurs. Any person who has worked hard, they know how hard it is actually to struggle to make a startup. They will empathize with you the most, understand your problems the most, and give you the right advice. So smart money, this is basically money from someone who can be a great mentor. So in my course of my startups, I've done a lot of mistakes. Some of them are either incredibly stupid and some of them are good mistakes. It would be sad if everybody, for example, starting today, makes the same mistakes as I did or keeps on repeating the same mistakes. So find good mentors, find people like me who either failed or who succeeded and who you can learn from. They can help you avoid some of the mistakes, some of the pitfalls, right? So if you're raising investment, also try to see or find people who have actually, who can be a great mentor for you, or even better, who can sort of help you with your startup, who's currently in the industry, or even better, someone who's well respected and known in that industry, right? When talking with investors, I talked about demand and supply. I suggest you talk to as many investors at the same time. Don't do one at a time, you will never build out momentum. What you want to do is, you want to talk with, in any negotiation, whether that's for sales, whether that's in any area of life, whether that's even if you're applying for a job, you want to do multiple things at the same time. So you basically build up competition. At one point, I was talking with 40 investors for one of my startups. And the fact is that fundraising is herd mentality. It's toughest to get the first investor to say yes, but once they say yes, बाकी investors उसको देख चले आते हैं, जो वो कर रहा है, फिर if they trust that guy, if that person has credibility, the other investors will come in quickly. And not just a yes, sort of a check would be much better. Capital is expensive, but also try not to get the lottery company where right now most of the investors, most of the rounds like great startups are doing are generally bad. If anybody asks for 50% of your company, it's a bad sign. You want to sort of avoid that. But think of the exit strategy that you want. how do you want to exit? Do you want to stay a profitable business, and or do you want to sell out or whatever? But at whatever stage you're at, you want to at least own more than 20% of your company. It's just my recommendation, but it's up to you what you might want to do. Then there's some mechanics. Again, I don't think we'll have a lot of time for this, but you might want to have in that meeting, you want to have an elevator pitch, talk about the problem, then the solution, the business model that you have, how big the market is, how are you different from the previous attempts at this market so far. So if you're starting an e-commerce company, how are you different, and how will you succeed where others haven't so far, and the team that you have, and the people, etc. There's some good slide decks, some recommendations. You can find these online. And yeah, so finally, I'd say again, as an entrepreneur, our job is to solve, is problem solving, and fundraising is a problem. And as an entrepreneur, our job is sort of to bust through that, right? There's a lot of rejection involved, but you need to look at this as a scientist. Think of this as doing an experiment, looking at the results. If it fails, you have to separate your idea from you as a person. If somebody rejects you, it's not you, it's just startup idea, right? So you want to basically build up emotional resilience, right? And in Pakistan, most people don't say no, just give you the long silence. So that's it. And